big webinar for you today. We're going to talk about quite a few things. Now, first thing I want to say is there hasn't been a lot of updates from Fannie Mae or Freddie Mac, for that matter, in 2024. But a lot of things have changed, and there's a lot of important stuff that we want to share with you to help make your life a little bit easier. So today we're covering the Florida Reserve Study law, the new structural integrity reserve study requirement in Florida that goes into effect on the 31st. This is in a couple of weeks. It's here. If you've been coming to our webinars for a while, then this should come as no surprise. We've been trying to scream it from the rooftops that this is happening, and it's gonna have a big effect on the condo market in Florida. So hopefully this is not news to you. If it is, hopefully you will learn what you need to know today in this webinar. We're also going to cover master insurance requirements. We get a lot of questions about that. I sent out, and I apologize for spamming your email inboxes with invites for this, but I'm really not that sorry. We're glad to have you here. I asked if anyone had any topic requests. Not one of you asked for anything to be covered in particular. So what we decided to do is just go through the stuff that we see on a day-to-day basis of questions that are common and try and cover those and help you have a better understanding of how condominium financing works. So on to that end, we're also going to talk about the 2025 budgets, the addendum requirement, and the approved by Fannie Mae status in CPM. It's caused quite a bit of confusion. We want to cover it again just so that everybody is on the same page with what that actually means. So that's what we're talking about today. I'll introduce the company, CondoAnalytics. We provide condo project reviews. That's all we do. So if you need help with your condos, you want to make sure that they're eligible for conventional financing or non-QM financing, we are the company that does that for you on a loan-by-loan basis. So CondoAnalytics is a wholly owned subsidiary of the Commonwealth Group. The Commonwealth Group does all sorts of other things. They do consulting. They help people get their Fannie Freddie servicer seller approval, contract underwriting, processing, QC. But it's mostly fulfillment type stuff and then consulting, helping people write QC plans. So that's who we are. We come from a compliance background. That's how this company started. We care about compliance and abiding by the rules that Fannie Mae and Freddie Mac have laid forth. So without further ado, let's get into it. We've got a lot to talk about today. First thing, SIRS, Structural Integrity Reserve Study, the Florida Senate Bill 154. We're going to talk about this a little bit. So this bill was unanimously approved by both sides of the aisle. Everyone seemed to agree that this needed to happen in Florida. It comes in response to the tragedy in Surfside. And there's quite a few things in there. I actually went and read the bill this week from start to finish. And there's some other stuff in there that I want to talk about that's, I think, good for condo lending. But the real thing that's important about this bill that we're looking at is the requirement of a reserve study to be performed on condo projects in Florida. So who does it apply to? It's only for buildings that are 3 or more stories. So if you're under 2 stories, you don't need to go out and do a reserve study. And then who does it apply to? HOAs existing on or before July 1st, 2022. So these are new projects. This could be a project that was built, less than 3 years ago. They still need to go do a reserve study. Now, that's not the most important thing that you need to remember about this. The most important thing is that they need to do the reserve study, but the HOAs also need to have a fully funded reserve account. That's the real kicker here. So we're going to get into this, and I have the actual verbiage from the bill here. You can read that. And then every 10 years, they have to do this on an ongoing basis. Now, this is separate from milestone inspections. There is some verbiage that says they can be done simultaneously, but milestone inspections are separate from this. This is a reserve study by a licensed engineer. It's going to come out and tell you everything that needs to be fixed, the remaining useful life of those things, and how much it's going to cost, and how much they're going to need to budget to the reserves in order to pay those bills when they arise. So let's talk about reserve studies. What is a structural item in a reserve study? Obviously, the roof, that's huge. If you have a whole new roof, you get weather intrusion that rots away, it causes mold, it warps beams, that causes all sorts of problems. That's a big one. Structure, including load-bearing walls or other primary members with primary structural systems. Fireproofing, electrical systems, waterproofing, windows and exterior doors, and any other deferred maintenance expense with a replacement cost that exceeds $10,000. So it's really what you would think it would be. It's a structural integrity reserve study. Anything that pertains to the structure of the building is going to need to be looked at and assessed for how much is this going to cost to repair or replace and how long, and how much are we going to need to budget on an annual basis to make sure that we have money in the account when we have to do that work. So I want to talk more about reserve studies, because if you guys are doing your own condo project reviews internally, you're going to have to start looking at these a lot more frequently. And we're already seeing this happen in Florida. If HOAs have been doing their job and managing their projects correctly, they've probably already done this. So part of Fannie Mae's requirement is that, so this is not a Fannie Mae rule. So let's back up for a second. This is not Fannie Mae saying this. However, if you want to work with Fannie Mae and you want to sell a loan to them, the project needs to be in compliance with jurisdictional requirements. So this is not a Fannie Mae rule, but in turn, just because it's now state law, it kind of is, but it's not Fannie Mae saying it. And they've actually been pretty quiet about all this. We're kind of waiting for them to say something to us about how this is going to be handled, but they haven't really commented on it. But what I want to do is, Dalton, if you will, and everybody, I think I introduced Dalton, but he's been in the business for half a decade. He's absolutely brilliant. And Dalton, will you just tell people, when you are opening up a reserve study, where do your eyes go? What are you looking for, and how do you clear these? And what's going through your head when you open up one of these things?
Sure. Yeah. And first of all, thank you for the intro. Always a great intro, Nick. I appreciate it. But yeah, so when we're looking at reserve studies, and you're going to, I imagine many of you have seen quite a few of these over the past year or so, especially with all the critical maintenance requirements and things like that as far as the addendum goes and whatnot. But just to give you a little roadmap of the reserve study. So the big things, and everyone looks a little different. So, unfortunately, this might not be an exact template every time, but typically, whenever you open the reserve study, you always want to read those kind of initial recommendations, especially on a structural reserve study like they're requiring now. There isn't a lot of room for interpretation. It's pretty clear cut. They should define priority items, things like that. And mainly in the beginning of the reserve study, you want to look for that funding section. You'll see a section where it shows how the percentage of fully funded that they are, what they would need to contribute to reserves to meet that full funding amount, things like that. So that's like, with the change or the requirement now in Florida, those are the kind of the first things we're going to be looking at is, how funded are they? How much money do they need? Because likely that's going to turn into a special assessment. So we got to keep an eye on that. And, what does their contribution need to be, per the budget? So we're going to have to take all those things into account. And like Nick mentioned, it'll be interesting to see what Fannie and Freddie kind of say about how they're going to take this requirement, because, that could change how, the 10, as you know now, with a budget on a full review, you need to have, 10% allocated to reserves, per the annual dues. So we'll be curious to see how that is going to change as far as guidance goes. If we're going to have to fully fund the account, we might have to be, funding the reserves by 50% to meet that jurisdictional requirement. So we will certainly provide an update once we get some actual guidance referring to that. But like Nick said, we really have no other option at this point but to try to meet the jurisdictional requirements so that condo is in compliance with their local law, which typically overrides Fannie Mae or Freddie in many situations. So like I said, just to recap really quick, take a look at the beginning of that reserve study, find that funding information, find those priority items. And then as you go down further into the study, typically midway or towards the bottom, there's always a section that'll show you the year by year expenditures. So you'll want to find that, see if it's stuff like, roof replacements, concrete restoration, stuff like that, or is it, tennis court refurb, things like that aren't quite as important. But you should see and again, those kind of smaller items might not even be included on these kind of studies. It'll just depend on who's doing it. But yeah, you just want to see the yearly expenditures, see what's planned out, and then compare that to the funding. And we'll kind of discuss as we get further down. I know you saw the 2025 budget kind of heading we had. Once we get down to that section, we'll discuss this a little more. But yeah, that's kind of the basic roadmap of the reserve study. The funding recommendations, and then the expenditure list there. So, Nick, I'll pass it back to you.
Great, thank you, Dalton. So yeah, that's a really interesting topic and point. I think is like, yeah, Fannie Mae says 10% has to go to reserves, but if the reserve study says that you need to be allocating significantly more than that, what's the deal? You know, is 10% still okay? What if they're not doing that? Probably an issue for Fannie Mae, but we haven't heard from them on this yet. So, all right. What does all this mean? Let's try to unpack this a little bit. So here's some headlines. I'm sure you guys have been hearing these stories in Florida. It's happening across the state. The next slide is just all headlines. I collect these as I see them pop up. As I mentioned, non-compliance with jurisdictional requirements renders a project ineligible for Fannie Mae. So you have like a double whammy happening here, right? If they don't do this reserve study, or if they have major issues and then they don't special assess for it, then they lose their conventional financing status. So then they can't sell the units. So you have this like perfect storm of stuff happening down in Florida right now. It's actually pretty concerning for us, considering this is all we do for a living. What does it mean for condo owners in Florida? Yeah, you're going to see a lot of special assessments this year. You're going to see increases in dues. We've seen projects that we've reviewed, some of these articles, we've reviewed these projects, and we've watched these dues go from $300 a month to $1,500 a month, plus, you know, $20, $30, $40, $50,000 special assessments. And these are not luxury condominiums. These are like $300,000 entry kind of homes. So these people don't just have giant wads of cash sitting around to pay for this stuff. So yeah, it's kind of a double whammy, because they might not be able to pay the special assessment, but they also can't sell the unit. So it's going to put a lot of people in a really, I don't know. We're going to see how this shakes out, but it is concerning. It's going to put a lot of people in a really tight spot. So here's more articles. I know I've been screaming this from the rooftop for all year, it feels like, but yeah, $20 million special assessment, $30 million special assessment, 17 million. I mean, this is real money. And so how does this shake out in the end? I don't really know, but I think if enough people in a project get hit with a big enough special assessment, they're not going to be able to pay it. They're going to get foreclosed upon probably, unless they have a really good property that a developer wants to come in, and it very well might be cheaper just to, you know, buy everyone out of their units for a fair price and then clean slate, bulldoze it, and start fresh and build something new on it. That very well might be how it shakes out. That's how I think it's going to shake out, at least, but we'll see. Next year is going to be very interesting in condo land. But so what else is happening right now? Yeah, you have the old reserve study thing, and all of these HOAs are going and getting the reserve study, doing the big special assessments, all that. At the same time, you have insurance premiums going through the roof in Florida. I'm sure there's a lot of people from Florida on this call. You all, I'm sure you've seen this just in your own single families or whatever. Insurance premiums have gone through the roof because we saw 3 major hurricanes sweep across the state this year, and a lot of $220 billion in damage. These insurance companies aren't stupid. They want to make money. They're for-profit institutions, and they're raising their prices, and deal with it. Unfortunately, there's not a whole lot to say about that, but it is happening, and that's also contributing to the increase in HOA dues, because that's where insurance premiums for the projects get paid out of. So one other thing that we've noticed that I want to talk about is we've seen document fees go through the roof right here. This is I don't know which document provider this is from, but this is how we have to order documents sometimes on like HomeWise, Condo Certs. In this case, I want you all to look at this because it's so crazy. I know I've shown this to some of you, but lender-specific questionnaire, if you want to order it for this one, $940. If you want the meeting minutes, add $200. If you want the budget, which we need to do a full review, $300. If you wanted to get all this stuff, you're talking about literally thousands of dollars just for the docs package, which is crazy. But you have to remember, this is not a free market up till now. And I do have good news on the next slide. This is not a free market and they can charge whatever they want for these things. It is a huge red flag for us when we see that, because they shouldn't be doing that, because they just have all this stuff sitting on their desktop. This is like, I don't know why they think they can get away with this. However, I read the bill, remember? There is a provision in this bill. I can't read it on top because it says I'm sharing, but and I'll send this to everyone that's on this call and everyone that registered after, and you can go through it. There's a link to the bill down here. But what this says is each prospective purchaser who has entered into a contract for the purchase of a condominium unit is entitled at the seller's expense to a current copy of all of the following: declaration of condominium, articles of incorporation, bylaws and rules and regulations, financial information. That's that $300 budget we just saw. It doesn't cover the questionnaire, the 1076, which they'll probably just increase that to $2,000 because they can't charge for these anymore. But the way I read this, I am not a lawyer. The way I read this is that sellers need to get this, and the sellers need to buy it so that we won't have to buy it. So I'm sure a lot of you know this, but what we do for lenders is we go out and we acquire all of the documents, and then we certify the project does or does not meet Fannie, Freddie, or FHA. If the seller is now required to go and do that and provide it to the buyer, then that's going to make our life a lot easier, a lot easier. And then there's one other thing in here. I don't know if it's in the screenshot that says that HOAs need to respond to requests for documents in 10 business days or less, after which they can be fined, I think $50 a day, for every day that they don't provide the documents. So you have the state of Florida, and we have a huge issue with this. Just sourcing documents is very difficult for us, for you, for whoever's going out and trying to get all these condo docs. It's really difficult. So it's nice that the state of Florida is coming in and saying, no, you can't drag your feet. You have to provide this in a timely fashion so that we can get our loans done. Now, so far as enforcement, we'll see. You know, like we really don't know how all this is going to shake out yet. But if they do enforce that and people start getting us these documents, that's great, and we're really happy to see that, because that's probably the biggest challenge that we face, is just getting stuff back from these HOAs in a timely fashion. So with that being said, we want to dive into some other subjects that are just common, frequently asked questions, and try and clear some stuff up for you. Dalton, if you will cover master insurance requirements for us, that would be greatly appreciated.
Absolutely. Yeah. And this is, I felt like this was the best place to start with some of the insurance requirements. This seems to be the most common question or most common obstacle that we've been running into, is verifying, sufficient insurance coverage. And so I think the one thing that's changed with the co-insurance requirements, things like that, is the verbiage is just very clear now. We have to have that 100% replacement cost. Now, what that means, and we just included the exact guidance because, like I said, it's pretty cut and dry these days, where it basically means that the policy has to state it's 100%, the insurer can state it's 100%, or you provide a replacement cost estimator to verify that the coverage is 100%. There's really no way around those three options. You don't want to just be accepting a policy that just says replacement cost. That really means nothing. You need to have that that affirmation, that verification that this is 100%. We run into it all the time for some reason, where certain insurance agencies will say, well, that doesn't exist. That verbiage doesn't exist in our, policy. It does. They can say that, hey, the project is insured at the, full amount at appraisal or something of that nature. There's ways to get that information. So, we want to just, kind of reinforce, don't accept at a, kind of a face value of, well, the insurance agent just says we can't get that or something like that. There's clear-cut ways to get it. You need to be getting it for supporting evidence in the file. There's really no way around it now. So huge emphasis on 100% replacement cost. That's the first place you should start with a policy. If you don't have that right off the bat, it really means the policy means nothing at that point. So, like I said, just follow the guidance there. you have those couple options. It's very clear cut. And, also there's other options as well, not to go too into the weeds, but, extended replacement costs can meet that requirement because it's saying that, they're going above the replacement cost value. So guaranteed replacement costs, there are some different options there, but you've got to make sure that it's at least 100%. So just wanted to kind of emphasize that right off the bat. And as Nick goes to the next slide here, we'll see kind of our other two. Is basically these are our other two that we run into quite a bit because there's different ways to basically confirm this, and there's different kind of options you have with it. So I just wanted to cover these two things here. Two items I'm sure you guys see a lot. Inflation guard. You need to have this or basically a version of it. Sometimes, and the insurance agent should provide that clear verification of, hey, we don't have inflation guard because it's automatically increased every year or reviewed annually. Agreed amount, things of that nature can potentially supplement for it. But you just need to have verification that there's an automatic increase in that coverage one way or another, basically. We like to go ahead, of course, best option, ask for it. Hopefully they'll confirm it. Sometimes it's not on policies, but they do have it. It's a weird kind of coverage like that. So want to verify, like I said, that they either have it flat out on the policy or some version of it. And the insurance agent can usually provide some clarification as to why they don't have it or what version of it that they have. Now, with that being said, we've been running into it quite a bit where, you have to verify if it's not obtainable in the market, then you technically don't have to have it, as it says right here in the guidance that we've included under it. Now, there's a difference between obtainable in the market and obtainable with the carrier. You want to be sure that you're being very careful when getting this verification of, hey, we don't offer it. If the carrier doesn't offer it, unfortunately, that's not necessarily saying that the market doesn't offer it. So you want to verify that. And now this is actually Fannie Mae's guidance. Now, Freddie, and same with building ordinance coverage as well. Freddie provides a little leniency here. The agents can state that the policy is not applicable in the market or to the coverage rather. So basically, if you get a confirmation from the insurance agent that says, hey, this coverage is not applicable to this, to this project for whatever reason, Freddie will actually accept that in lieu of the coverage. Like I said, Fannie's a little more strict. If it's available in the market, you got to have it or an equivalent. So I won't harp on that much further, but just with a lot of these insurance items, there's a couple different roads you can go down, but you just need it firmly, verified and documented. So now moving on to the ordinance or law coverage. Go back one more. Yeah, there we go. Ordinance or law coverage. Similar situation. This is Fannie's guidance. They're pretty strict about it. You need to have A, B, and C coverage. Pretty much, no really way around it, right? Unless, basically, if it's not obtainable in the market, same with the inflation guard, then you can, get around it. Again, you want to make sure that it's actually market and not carrier specific. So again, they should be able to verify that for you. Freddie provides you the option to get around it. If they don't have the coverage on the policy, you can verify that the project is basically compliant with all current zoning codes, things of that nature. The appraisal will typically be your best place to verify that. So in both cases, Freddie, a little more lenient. But you want to go ahead and just start with just trying to verify these right off the bat, because if you do have these in place, you're even in a better situation for Freddie, of course. So again, these are these three things that we've just discussed are going to be needed on every policy. And again, they're the three things that kind of have the most variable to how they're defined, or different things can kind of, equal that coverage and stuff like that. So just wanted to give a quick overview of those. And go ahead to the next one, Nick.
Budgets.
Yep, 2025 budgets. All righty. And I saw someone mention in the comments about ACV. Freddie is actually, I believe, going to be releasing some updated guidance on that. I've heard that in the wind recently. We're not going to report on it quite yet because it's not firmly in place, but they have been, Freddie's going to give a little lenience on the ACV. Fannie Mae, if it has ACV on the policy, it is ineligible, period. But Freddie is going to be a little more, I think is going to release some updated guidance in the near future here, providing a little leniency there. But moving on to the budgets, getting away from the super fun insurance stuff. As we are approaching the first of the year, we need to have these 2025 budgets. We cannot use a 2024 budget, once the first rolls around. This is something the HOAs should have done, in the months leading up to this. We see a ton of projects already that already have these in place, these budgets ready to go. So we need to be getting these updated budgets. So often do we get the feedback even through, March of, well, it's just the beginning of the year. They haven't had time to do their budget. Unfortunately, that's, a lack of financial preparation on the HOA's part. Fannie and Freddie don't really care about that. They want to see that 2025 budget. So make sure we're getting that. And this kind of leads us back to the Florida stuff here. So it'll be interesting to see, assuming Fannie and Freddie release kind of some specific guidance on this, at least for the jurisdictional requirement. We're going to want to be reviewing these 2025 budgets to ensure that they have the necessary funding and expenses for the items on the reserve study. So that's going to be a big piece of it. We're going to need to see that they're, special assessing if necessary, that they're allocating sufficient reserves to get the full funding, that they're allocating or that they're expensing those necessary repairs, things like that. So the 2025 budgets specifically in Florida, I think, are going to get pretty interesting. They're going to be pretty tough to decipher, I'm sure. A lot of comparison with the reserve state, things like that. So looking forward to kind of seeing how that plays out. But and always a kind of reaffirmation here, 10% reserve allocation. Gotta have this. This is one of the most common things we run into with the budget when a project's not allocating sufficient reserves. There's a couple ways that if we get to that close to that 10% amount that we can potentially, utilities, if there isn't an actual reserve assessment that's balancing the expense, you can take, that reserve allocation out of the assessment. Tough to explain without getting too into the weeds, but, there are some ways to kind of get that allocation up, but flat out, we've got to have that 10% reserve allocation of the annual dues. Or it is no good. With that being said, there is the reserve. I always like to mention there is the reserve study in lieu of the reserves allocation option. If you have a full reserve study, it can't be just a useful life reserves. It has to be a full reserve study, reporting on condition, expenditures, all that kind of stuff, pictures, everything there. If you have that and the HOA per the budget is either fully funded already per the recommendations of the study, or if they are contributing what the study recommends. You see this sometimes with newer projects. They recommend, hey, this not really any repairs. If they're just allocating this, it's acceptable. If you have something along those lines, you can use that as a supplement for the reserve allocation. Not often that it works out. You do have to hit quite a few bullet points. But just an additional comment there is, again, this is one of the most common things you'll see with the budget. So I know that was a lot of information there. Hopefully everyone grabbed onto at least a piece of it. But Nick, you're welcome to flip to the next slide. All righty. This has been a hot topic recently, and I'm a little surprised, to be honest, that it has been coming up so much this far into the year. You need to be getting a questionnaire addendum. One way or another, that information has to be answered. We have seen, auditors not even accept the review without having it sufficiently completed. They don't even want the supporting information. They want to see the actual addendum completed in the most extreme cases. So what it comes down to is that information has to be verified, and that includes, are there any inspections within 3 years? Reserve studies within 3 years, deficiencies in the project, special assessments, outstanding loans, etc. I'm sure you guys have seen this form nonstop this year. You need to be getting that completed, and that's kind of the bottom line. At CondoAnalytics, if we do not have a sufficiently completed addendum, we will not approve the order, and we stand firmly behind that because, again, if the HOA is not willing to answer that information on that form, it is a huge red flag, and I would never recommend that you proceed if they will not sufficiently answer that. And by sufficiently answer, obviously, if for whatever legal reasons they won't answer because it's a broad question about are there any known deficiencies, that kind of thing, we can use some supporting information to verify that there are no ongoing projects, things like that. But as far as inspections, special assessments, if they won't respond to those questions, huge red flag, huge red flag. So worth noting too, that's how we handle it. If you have an investor that doesn't require that form, by all means, enjoy it and don't get it filled out. But in every other case, without specifically being told otherwise, I would not proceed with a file without having that information completed for you, basically. So that's kind of where we stand with it. We've put the guidance here. This is actually, there's been some confusion with this recently where people are getting this mixed up, basically saying the addendum is a review specific requirement, or that information is review specific. If I have a limited review, I shouldn't have to get this. That is not true. This is project standards related, not review specific. So it is project standards that you verify that information. So you're always going to want to get it. Again, if they won't fill that out on the front end or provide, applicable info to verify any of the questions they didn't answer, huge red flag. You should not proceed with that. That's where we stand on it. So get those addendums done and, save yourself the hassle of surprises down the road or something that comes up in the resale cert or something like that. Or even worse, something that comes in a submission in that project from another group that did all that information and found an issue. So, want to go ahead and get that out of the way just so you don't have any surprises down the road. And again, we included that. This link goes to the facts section that's updated as of last month and will give you basically a lot of clarification on critical repairs, ineligible characteristics, special assessments, all things like that. It'll give you a lot of clarification. So highly recommend at the end of this presentation, please open that up, give it a read. I think it might answer a lot of questions that you may have, rumbling around your head there. So Nick, feel free to go to the next one here. If you've been on our webinars over the past year, you've seen this slide every single time. I always like to include it. It's only something that becomes more, relevant by the day. And again, with the Florida stuff considered, you're going to see this a lot. So just want to make sure that you're hitting your checklist of special assessments. For all review types, any units greater than 60 days delinquent on their special assessment payments, that limit is 15% for all review types, including limited review. So you always want to be verifying that count. Typically on the questionnaire, they will not answer that. They will only answer for the common assessments. So always make sure you're following up on that. And again, just to comb through it really quick, you're always going to want to know what's the special assessment for. If tied to repairs, what is the scope of those repairs? Are they critical in nature or just general maintenance? What's the status of the work? And how many payments do you have left? Freddie requires, if you have over 10 months of payments, it has to be included in the DTI, things like that. So always do your due diligence, the special assessments. And again, you're going to be seeing these probably even more in the coming years. So I just want to make sure you've got a kind of a good process there. And we typically provide that with all of our reviews, as well as statement from the HOA, just kind of verifying that info, unless it's clearly defined. So always want to be doing that. But I won't harp on that too much more because, like I said, it's been on every webinar. So feel free to go to the next one, Nick.
Oh yeah, to that end, we've had quite a few webinars this year. These aren't all of the changes. There have been some other small changes, and I don't know if I already said this, but I encourage you all to go to our YouTube channel if you want to see those other webinars where we've talked about co-insurance and some of the small changes that Fannie Mae has actually made this year. I encourage you to go watch those videos. We've already talked about it. It's up. Just go to the Commonwealth group. That's our YouTube channel. That's our parent company. And if you want to get clarification on any of those things, that's where you do it. We wanted to provide some new material today, but take it away, Dalton. Sorry to interrupt.
Yeah. And a lot of our past webinars have a lot to do with, deferred maintenance, things like that, as the CPM requirements came into place and stuff like that. So a good refresher. Again, though, that facts section sheet that we provided in the previous slide answers a lot of that info, and it's the most updated info. So would recommend checking that out before anything else. Even though I hate to deter views of the old webinars, I would definitely start there. Just since it's the most updated. But so this is a common point of contention that we've dealt with quite a bit. So this is something you need to kind of be careful with. Again, same thing with the addendum. If you have an investor that says, hey, if it's approved by Fannie Mae, get us the insurance and we'll let it rip, then by all means, enjoy that and just get that, just get that basic info and proceed, assuming there's no issues with the insurance. But Fannie Mae specifically states that if a lender becomes aware of any information that could impact the eligibility status in CPM, such as deferred maintenance or major litigation, just as two examples, they must notify a CPM management team with the relevant data and information. What this means is that just because a project is approved by Fannie Mae does not mean that it cannot lose that approval. And this can come in the form of many different things. You could get our process, the scope of our service is to always do the review. Because again, a lot of HOAs too won't answer some of these questions about maintenance, special assessments, litigation, stuff like that without you getting the questionnaire anyways. I'd say 98% of HOAs would not answer that question without getting the questionnaire anyways, from our experience. So the scope of our service is to always just go ahead and do the review. That way you can get ahead of any of these items. If there is something you need to redisclose, you're at least aware of it at that point, and you can do so or potentially, get it remediated, whatever it may be, just so you don't have to deal with that issue down the line. You don't want any surprises at the closing table, certainly. But yeah, Fannie, reserves the right to change an eligibility decision at any time. And if someone submits an order over top of yours where they did verify that information and redisclosed an issue, that loan you did is coming straight back saying, why didn't you guys verify this? That kind of thing. And you may go many orders where you get by without any issue and no surprises come up, but you want to be prepared for that one time it does. You don't want to be there without any verification of those at least main items there. And again, like I said, all those questions are answered on the addendum. Like any of the addendum stuff is going to be a potential item to overturn an eligibility. Things like litigation, obviously, kind of not in that addendum section, but on the questionnaire. So just something to think about. Like I said, if your investor will accept it as is, by all means, proceed that way. But for our service and how we like to advise our customers is go ahead and do the review so that you are fully aware of any eligibility issues, so that when everything's signed off on, that there's no issues, that there shouldn't be anything coming back, and you can proceed, like that. You don't want to be caught on the other end of it where Fannie says, hey, what about this special assessment? What about this litigation? And all of a sudden that eligibility is overturned. So this is specifically from the guidance. So, just worth noting there. Obviously, Freddie, with not having CPM, their kind of approval system's a little different. So again, this is kind of Fannie specific here, but yeah, highly recommend doing your due diligence, verifying these kind of main eligibility items and avoiding any of these, kind of surprises down the road here. So Nick, feel free to switch to the next one.
Well, Dalton, that concludes the educational piece of this. For all of our customers on here, I'm going to do a quick commercial. Word from our sponsors here. Yeah, I've actually, honestly, we've already done this on all the other videos, but just so you all know who we are. We do this for a living. We do condo project reviews. We do it for you. So you have Dalton looking at every single order that comes through the door, going through it with a fine-tooth comb, making sure that it's not going to end up being a repurchase. That's what we do over here. And we've been in business for over 10 years. We've done over 33,000 condo projects in the United States, and we're the best in the business. There are other people in the space that do this work, but I have it on very good authority that we are the best in the business at what we do. And if you would like to do a demo, please give me a call or shoot me an email. And I'd be happy to take you through the system and show you how everything works. I can show you a little bit right now. Basically, you just put in some key details about the project. We only need to know a few things, and then we take it and run with it. We'll go out and order the insurance, order the questionnaire, get clarification on anything from the HOA, and we'll take the condo burden off of you, and we will just do it for you and deliver it back in a nice, neat little package that tells you whether or not the project is eligible. So this project here in this example, this one is ineligible because they were not allocating 10% to reserves. But our whole work product is a certificate along with all of the supporting documents that you would have had to gone out and get anyway. So we take all of those documents, distill it down into one neat little package, and answer everything that you would need to put into CPM, all of the critical information about the project that Fannie Mae wants to see. We go out and just distill it down so you have it all in one place and not in all these different forms. And then we give you all of those supporting documents as well. Because honestly, our form is worthless without the supporting documents. But that's what you're paying for, is for us to get the documents and then tell you whether or not it meets the guidelines. But you'll recognize all of these questions in here that you find on our certificate. Does the project contain any non-incidental business operations owned by the HOA? Like, these are all just standard questions that we need to answer in order to determine whether or not it meets Fannie Mae, Freddie Mac, FHA guidelines. So I won't spend too much time on this, but I just want to give you an idea of what the work product is. And, it's a full review of everything that's going on at the project. If there's litigation, we determine if it's major or minor. If there's an issue with the insurance, we'll tell you what's wrong with the insurance, and then you can work with the HOA to remedy that. And yeah, we go through, we look at everything, and we give you a nice, clean package that tells you everything you need to know. That is the conclusion of today's webinar. There's, like I said, not a lot of huge updates from Fannie Mae this year. On a personal level, there's been some big updates over here. I got married this year, so sorry, ladies, I'm off the market.
Congratulations, Nick. You did
These
it.
are some additional resources for you. I hope you all have a wonderful Christmas and New Year's. Thank you for coming to our webinars. We love doing these for you. We hope that they're educational and that you get something out of them. Anyone that's registered for this, I will send you a YouTube link. And then if you want a copy of the slide deck to get those links to, just shoot me an email directly. It's N as in Nick DeSantis at thecommonwealth.net. I'm happy to send you a copy of the slide deck as well. Give me
Nick,
a couple days.
Do you want them to send you any questions from the webinar as well to your email? I see a couple questions. I want to answer those offline.
Yeah. Do we want to just, can we do them now, or are they crazy questions?
Let's just go ahead and do it just for the sake of time and organization here. Let's just go ahead. And if you have any questions, Nick, do you just want them to email you your email with any questions?
Yes, please.
Yeah.
Please.
Let's go ahead and do that. And we'll be happy to get you a response, whether it be guidance or service related.
Yeah, I can't see the questions, unfortunately, but yeah, shoot me an email. We'll be happy to respond to any questions that you have. And then, or just give me a call. Call the main phone line for CondoAnalytics, and I'll be there. So anyway, I hope everyone has a very Merry Christmas and Happy Hanukkah and a wonderful New Year. Be safe, and thanks for coming, y'all. I think we're going to shut this thing down.
Appreciate everyone's time. Y'all have a great holiday season and a Happy New Year.
Thank you, everyone.